The Fed's policy to purchase and still buy bonds, interest rates are rising. And now billionaire Warren Buffett is betting on even higher rates. Bloomberg reporting earlier today that his firm Berkshire Hathaway sold $1.5 billion in mostly fixed rate debt yesterday to retire floating rate notes. Well, joining us right now to talk about it, Ajay Rajadhyaksha. He's head of fixed income strategy at Barclays Capital. So we talk about Warren Buffett and what he's doing. Does it make sense to you? And does it say to you, Ajay, that indeed higher rates are on the way?
Oh, most definitely. It does depend a little bit on your time horizon, mind you. So rates have had a big move up in the last 6 to 8 weeks. So over the next 3 months or so, we probably won't see a continuation of that. But over the medium term, and by medium term I mean over the next 12 to 24 months, rates should head higher. And I think the biggest issue is going to be not just the recovering economy, but also our fiscal situation and our debt, which keeps growing.
When you say that, Carol and I both, and probably everybody else, ask the question, how much? I mean, how much do you expect them to head higher? I think we had Byron Wien yesterday forecasting 5% on the 10-year by the end of 2011. What are your forecasts? What are your expectations?
5% we think is a bit too much by the end of 2011. By the end of 2012, I can see that number being realized. It really boils down to when the market starts worrying about the U.S. deficit situation. Right now, it's not, by the way. So this move higher in rates, we don't think has been occasioned because all of a sudden the market is worrying about whether the U.S. can make good on its debt. When that changes, and we don't think it happens in 2011, but when that changes, I can see the 10-year going about the 5% level you just mentioned.
It doesn't have to worry that the U.S. can't make good on its interest payments, right? I mean, as soon as the Fed bid comes out of the market, it's got to be a concern for anybody who's in Treasuries.
Well, the Fed bid can often work with a lag. So if you remember, the Fed was also a big buyer, in this case of mortgage-backed securities,
of course,
by March 2010, right? And they stopped buying, and mortgages were supposed to do poorly. Instead, the fact that the Fed would come out was so well telegraphed that mortgages took it on the chin and then were perfectly fine after the Fed stopped buying. So there doesn't tend to be a perfect correlation between when the Fed buys and what happens to interest rates. I would not be surprised if rates do not rise as much as some people are expecting simply because the Fed stops buying. Again, it boils down to when markets worry about the U.S. fiscal situation, not just about whether the Fed can buy that debt or not.
So, let me throw one thing into also the U.S. fiscal situation. This is something we talked about with Steve Kroll. I mean, he questions whether or not the U.S. will maintain its AAA rating. He thinks not. Others say it's not going to go anywhere. If that does play out this year, how does that impact things?
Well, if it plays out this year, then I might not be on television much more. But
Armageddon.
Well, is it Armageddon? Because some people say, it's already factored in the market. We know about the U.S.'s fiscal situation. To me, it would freak out the markets globally.
Yes, it is absolutely not factored into the market. One easy way to look at it is to look at sovereign CDS markets. U.S. sovereign CDS has hardly moved over the last several months. That is a small market, but Spanish CDS or other European countries, those CDS markets move quite a lot. They move in sync with how the sovereign debt is doing, right? So we don't think that is factored in at all. If things got to the point where the rating agencies were seriously even considering a downgrade of the U.S. AAA rating, I think bond yields would be much, much higher. And I actually think that's Armageddon is a strong word, but things would be very bad.
Well, how much higher then?
Your guess is as good as mine. Pick 200, 300 basis points. This is a very big deal. If the rating agencies think the U.S. fiscal situation is at a point where they have to downgrade the U.S. AAA rating this year, I think rates are going to explode.
What if we see, I mean, even if we keep our AAA rating as a nation, what if you see a state default on its debt? Does that seriously mess with the Treasury market's mind?
No, I actually think it will spook the muni market, obviously, but I don't think that will necessarily translate one-to-one into a question of whether the federal government can make good on its debt or not.
Hey, Ajay, got 10 seconds left here. So we know what Warren Buffett's doing. What's your advice to investors at this point in terms of what's going on and your expectations for rates, just quickly?
Buy inflation projection long term. You might not see much inflation over the next few months, but over the longer term, given what the Fed is doing, that seems a safe bet to make.
All right, we're going to leave it there. Ajay, thank you so much. Ajay Rajadhyaksha, he's the head of fixed income strategy over at Barclays Capital.